During the first year of its operations, therefore, how much was beginning inventory, everybody said?
0.
U Company produced 50,000 units, 45,000 of which were sold for $15 each. Raise your hand if you know ending inventory. Ending inventory. Come on, let me see those hands. I have 2, 3, 4, 5. Come on, a whole bunch of people need to tell me they know ending inventory. Yes? Say the amount of ending inventory. Everybody said?
5,000 units.
5,000 units are in ending inventory. Let's have a prediction. Predict for me whether variable and absorption costing will give you the same answer for net income. Same or different? Say something.
Different.
You're going to give a different answer. Now, predict for me which will be larger or smaller, and tell me why. Are you ready to articulate a prediction? Which is going to be larger or smaller? Tell me why.
Absorption will be larger because when inventory is larger, absorption is larger.
So that sounds like you have that memorized.
No.
You know it. There's a difference, isn't there, Nick? Is he right, class? Agree or disagree? Agree or disagree? Didn't hear you? Agree for different reasons. Ooh, let me hear there's different reasons.
Well, when you have absorption, your fixed, your variable cost and your fixed cost, when it shakes out in the end, you'll end up, it will reflect more than what you would on variable cost. But it's because under
You quitting?
No, I'm not
Okay,
quitting.
okay. I'm listening. I'm patient.
I'm trying not to burn up. Okay.
I like the shakes out part.
Well, yeah, but when it shakes out, you're gonna
I didn't know that was an accounting term. Go ahead.
You're gonna have your net income for variable costing once you account for the fixed the raw materials that are unused, or the raw materials that are unsold, or okay.
You need to take breath.
Okay.
Alexis, I seem to sense that you didn't see that inventory increased. Have you now determined that to be true?
Yeah, actually, I just figured it out.
Have you figured it out?
Yeah.
Okay. So inventory increased. I want one person to give me a shot at variable will be larger or smaller, absorption will be larger or smaller, and why?
Absorption will be larger because it includes manufacturing overhead into the costs, like the fixed costs.
So it'll be larger.
Mm-hmm.
But I don't see why. It is true that the fixed manufacturing overhead is going to be part of the product. But what makes that larger? Rochelle?
Because any inventory still has all of the profitability into it, and so the variable is immediately fixed out.
Variable deducts those fixed costs now. And absorption doesn't deduct those fixed costs now because they're part of inventory. They get carried to next time period. And that makes variable smaller than absorption. That is correct. And you were correct too. You just didn't take it all the way out. Okay? So, let's keep reading. Here's some good information. Notice that it's not in the format of an income statement this time. Another handout we've done, we had an absorption costing income statement, and it asked us to do a variable costing income statement from that information. This information is bits and pieces, various subtotals. 1, determine the amount of gross profit. We would do that on which kind of income statement? Would that be a variable costing income statement or an absorption costing income statement that would help us do that with?
If we do have gross profits, could be absorption.
Yeah, but they're going to ask us to find gross profit, so we don't have it yet.
Right.
So which technique are we going to use to find it?
Absorption.
That is absorption costing. can you help me? Let's just do us an absorption costing income statement, shall we? How about we put a good heading on it? And right after the good heading, we
Sales, I think.
sales. Rick, you want to tell me how much sales are?
675,000.
That would be 45,000 units sold at $15 a piece. That's $675,000 of revenue earned. Right, Whit?
Right.
You're off the hook. I would really like for you to be a step ahead and not just taking notes. I know I say that, and I've been saying it since day one. Are those shorts that you're wearing today? May I remind all of you that shorts are not dress code, and that I would appreciate it if you wouldn't wear shorts to class next time or the final exam. Okay? Please. What was I saying?
After
Oh yeah,
sales.
don't take notes. Be ahead. Solve it, but don't be a step behind just waiting for somebody else to do the answer. You're supposed to know how to do this. We want to subtract something from sales to get gross profit, the question we've been asked to find. May I have some help? Jeff?
Cost of goods sold.
We're going to deduct cost of goods sold. We're going to determine cost of goods sold. How, Jeff?
By the goods manufactured. because
Is
we
it
don't
just
inventory.
440,000? Is it just given?
Yep.
Cost of goods sold is 440,000.
Yes.
What do you think, class? Cost of goods sold 440,000? I heard a male voice on this side of me say no.
I think not.
Was it you, Toby?
Yeah.
Talk to me.
Well, it's for 50,000 units, but we only sold 45,000.
So this 440,000 is the cost of producing
50,000.
50,000 units. Wouldn't it be all right to just deduct the whole 440,000 now?
If you're gonna do it now, you gotta add it up again.
I don't understand what that meant.
Well,
I guess when it all shakes out, I'll understand it.
I don't think so. No.
Toby,
No.
is it okay to deduct the cost of 50,000 units from the revenue earned from selling 45,000 of those units?
No.
That's a violation of which principle in accounting?
Matching.
You were tardy that day that we talked about that? Tucker?
Matching?
That wouldn't be matching. So your temptation would be to subtract the whole 440,000. And I need you to think about that. That 440,000 is the cost of goods incurred to produce 50,000 units. How can I get from the cost of 50,000 units to the cost of 45,000 units that I would rather do? The eraser dust.
Well, yeah, I was working ahead though.
Oh, good for you, Whit. Jeff, aren't you the one that started me on this path?
Yep.
Help me out.
Ending inventory.
Ending inventory consisted of how many units, Jeff?
5,000.
5,000 units that should be valued at what price, Jeff?
$15.
That'd be the sales price.
Sales price.
Somebody help Jeff out.
$8.80.
Whew. How did you get that number?
I took 440,000 divided by 50 units. I got $8.80.
Let's bask in that right answer. Whoa, 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 just slow down. Let's let them catch up. That's good. I need an auditor on $8.80.
That's correct.
Yes?
That's right.
So let's take the 440,000 we spent, divide by 50,000 units, get $8.80. Is that I'm doing something wrong hand or?
That's a question.
Okay, just a minute. And then what, Jeff?
Multiply by 5,000.
Multiply that by 5,000 and say that ending inventory is 5,000 units. Ooh, I see a typo on this. Oh, no, maybe not. How much, Jeff?
44,000.
44,000 is ending inventory. Toby.
Do we calculate the fixed manufacturing overhead?
Well, you tell me. It's a good question. What do you think? This 440,000 includes fixed manufacturing overhead or not?
It includes it.
I'm doing absorption or variable this time.
So,
I should include it or I shouldn't include it. I should include fixed factory overhead in this or I shouldn't. Toby?
Absorption, you should.
I should. So we're okay?
Yeah.
Good, Toby. It's good to make us think it through. Make sure we're right. So, I've got the cost of 50,000 units, 440,000. The cost of 5,000 units, 44,000. When I subtract that 44,000, I'm going to get the cost of how many units? Everybody said?
45.
Come on, more people than two. This is 45,000 units that cost me how much? Say a number.
396.
396,000 is cost of goods sold. The problem asks us to find gross profit. We're making progress. We're almost there. Who's going to help me finish it? Sam? You know what's funny about that, Sam? You know what's funny about that? I had decided to call on you before you raised your hand. It was one of those moments. That's pretty cool. It's the absolute truth. Sam?
I got sales minus the cost of goods sold.
Sales, 675,000 minus cost of goods sold, we just determined to be 396,000, is gross profit, Sam, of
279,000.
auditors.
That's right.
$279,000 of gross profit. We have now answered the first question. While I've got this slide on the screen, don't you think it'd be a good idea just to go ahead and finish this income statement? Yes or no?
Sure.
No.
Well, the rest of us are going to.
Keep moving.
You just chaw on your ice all you want to. We're going to do this. Because I think we can do it all in one fell swoop here. Get me from there to net income the fastest way possible. Somebody. 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 Toby.
Minus operating expenses.
Which were
202,000.
divided by 50,000 times 45,000?
Not sure. It doesn't say 50,000 units.
It says that in the opening paragraph. Jeff?
Won't those stay the same no matter how many units you want?
Yeah, Jeff. $202,000. That inventory doesn't have anything to do with that. These are expenses. Now what? Somebody new? Gross profit minus expenses is called net income is how much in this problem? $77,000. If you're with me and you know it, say amen. If you've got a question about this, you ought to ask me right this minute. Question 3, look. Determine net income under absorption. Aren't you glad we just did it, Shane? 2, determine the amount of contribution margin. Well, maybe we should start over with this a variable costing income statement. Let's put a good heading on it. Let's start with sales. How much are sales, Nick?
675,000.
675,000 is the same number we earned before. It's the same number, variable or absorption, doesn't matter. From sales. I could have gotten you right then. We need to subtract something. What is it?
Variable cost of goods sold.
Variable cost of goods sold as opposed to cost of goods sold.
Right.
Could you lead me through the determination of variable cost of goods sold, Whit?
Yes. We'll have to add, to the side of it, we'll add direct materials, direct labor, variable manufacturing overhead, and variable operating expenses.
Interesting. So I'm afraid you're going to get in trouble doing that because remember on the last one we just established that the 202,000 did not become part of inventory. And I'm afraid that you're going to include those expenses in inventory down that path.
Okay. So
But I liked a whole lot of your answer, Whit.
don't add variable operating expenses.
Let's go through it one more time. I think I heard you say add the materials, labor, and variable overhead because those 3 costs are variable. 130, 150, and 100. Do you see another way that we could do this, Whit?
We could just take the 44,000, 4,400.
I got it.
minus the
I got it.
60,000.
That's what I had in mind. you could take the $440,000 total given and exclude the $60,000. Either way, you get variable manufacturing costs to be how much, Whit?
380,000.
I got 380,000. Whit got 380,000. What do you get? Are you with me? Is it okay to deduct $380,000 worth of cost from this revenue of $675,000? Yes or no?
Yes.
Whit, is it all right to deduct $380,000 worth of cost from $675,000 worth of revenue? Yes or no?
No.
A minute ago you said yes. I'm a little confused.
I just re-figured out that it says the production costs are at 50,000.
You got your wits about you?
Yes.
Yeah.
Thank you very much. So, Whit, how many units of revenue is this?
50,000.
And how many units of cost is this? Oh, stop.
Excuse me.
How many units of
45,000.
revenue is this?
45,000.
And how many units of cost is this?
50,000.
Not good.
Right.
You went on the hook or off the hook?
On the hook.
Okay. How are we going to get there?
We'll find 90% of 380,000.
Interesting. Very interesting. I think it would work.
So,
We're not going to do it that way.
okay.
Explain it to me a little differently.
Let's see.
This is the cost of 50,000 units.
Right.
I want to get to the cost of 44,000 units. What's this missing number right here?
44,000.
This is how many units?
45,000.
This is 45,000 units. This is 50. This is 45. How many is this?
50. Oh, 5,000. That's
A little birdie told you with a deep voice
I found that out.
on row 2, seat 12.
There's no birdie over there.
Yeah, it looked like it to me. Blabbermouth bird. Whit,
So that's
this is ending inventory, isn't it?
right.
So, we manufactured all of these. We sold most of them,
Right.
but let's deal with the ones we didn't sell.
So
5,000 units in ending inventory should be valued at
44,000.
right there. Yes, Whit?
Yes.
Yes, Nick?
No,
What's the matter, Nick?
it's not very,
Pardon me?
or it's not, that is from, that's from the fixed, or everything, and then this is variable.
It looks to me like we need to go ahead and shake this out, though.
Yeah.
Somebody explain this to me, please. I need to hear it, Tucker.
So that less ending inventory includes labor, materials, and variable manufacturing overhead and fixed manufacturing overhead for absorption.
So
And-
this is the problem. This has fixed cost in it.
Yes.
And this doesn't have fixed cost in it.
No.
And we don't want ending inventory to have fixed cost in it. So we shouldn't use the 44,000. How are we going to do this, Tucker?
We are going to find.
If we spent $380,000 manufacturing 45,000 units, sorry, 50,000 units. Who corrected me? Thank you. How much did we spend per unit in variable cost? Toby,
7.6.
$7.60 each. Is that what you said? Back to you, Tucker. Now what?
So now we're going to do 7.6 times 5,000.
Is correct.
How did we get the 7.6?
We took this number, all the variable costs that you so eloquently found us,
Okay.
and divided by the 50,000 units we produced. We incurred this many costs to produce 50,000 units. It's the same process as we did a minute ago. We're just excluding the fixed cost from the decision, like Bentley said earlier today. Right, Bentley? Are y'all with me or not? Per unit, $7.60, Toby? Tucker says 5,000 times $7.60. Who's got me that number? Chriselle, do you?
38,000.
One more time?
38,000.
38,000 auditors. $38,000 of ending inventory. I've got 50,000 units minus 5,000 units is 45,000 units. I've got 380,000 minus 38,000. That looks like it's about 10%. 90% of that number, Whit, is
342,000.
342,000. Does it make any sense, Whit?
Yes.
The reason I reject the 10%, 90% line of thinking is it just worked out in this problem that way. And I wanted you to see the mechanics of it.
Right. In real life, it'll be something random.
It won't be that easy to figure in our head, would it, Whit?
No.
No. If you've got a question so far, you could ask me right now. Let's talk about this subtotal. Sales minus variable cost of goods sold is. I need a new hand up, a new volunteer. Somebody talk to me quickly, please. Aaron. What's that?
Would be the contribution margin.
That is not contribution margin. I'm so glad you made that mistake in my presence. Actually, we could say some other margin. It's going to be the same number.
Manufacturing.
It's manufacturing margin. And do you have me a number, Aaron?
In 2 shakes of lamb's tail.
2 shakes of a lamb's tail.
333,000.
I always heard that 2 shakes of a cow's tail.
Really?
So at your house, you say lamb's tail?
On Pulp Fiction.
Okay, before Pulp Fiction, who said cow's tail?
We were in the line when Pulp Fiction came out.
Well, he apparently knows something about it. Do you have me a number?
I do.
What?
$333,000.
$333,000 of manufacturing margin needs to be reduced by something. Who's going to talk to me right this minute? I'm getting frustrated with this. How about Dustin?
Subtract the expenses.
Subtract all the expenses. Cost and expenses.
Variable.
The variable ones. Oh, variable expenses. Just the variable expenses.
Sure.
How much?
86,000.
Didn't hear you.
86,000.
86,000 of variable expenses needs to be subtracted. This is a variable costing income statement. We want to subtract everything variable first. Variable cost, variable expenses. What's the name of what we get, Dustin? What amount did you get?
$247,000.
Auditors.
That's right.
Describe contribution margin to me in your own words. 2 volunteers. What's contribution margin? Shane?
Direct materials, I should say sales minus direct materials, direct labor, and your variable expenses. That's it.
I think I'm with Toby. I didn't hear you say it.
Your direct materials, or sales minus direct materials, direct labor, variable manufacturing overhead, and your variable operating expenses.
That is correct. The revenue you earn minus the variable costs and expenses you incur. Yes, Shane?
Yes.
What's contribution margin in your mind? Can you articulate the idea of contribution margin? Please. Alexis? Did you have on that call on me look on your face?
No.
No? Sam? Come on. 2 weeks into this, Sam. Toby, what's contribution margin?
Sales minus variable cost and
Sounds too much like Shane's definition. I was looking for something different.
That's what it is.
Tucker, what's contribution margin?
It's sales minus all the expenses before you subtract fixed.
It's the amount of the excess of sales over everything variable that's available to cover fixed cost and
Fixed cost?
fixed cost and
Expenses.
no. What if we've covered everything fixed?
What's the extra money?
It's not money. What if we had more than enough to cover fixed costs
Net income.
and provide for a net income? Yes, everybody? Contribution margin is the excess of the revenue that we earned over everything variable that is available to cover fixed costs and provide a profit. Don't just crunch numbers and not realize what you have. We need to know what we have so we can do something with it. Let's take contribution margin and get to net income.
Couldn't you just say that contribution margin is manufacturing margin minus your fixed expenses?
You could say that, but it would be wrong. It's manufacturing margin minus variable expenses, but we've made manufacturing margin an optional definition. I'm not requiring you to know manufacturing margin, so I don't like defining this in relationship to manufacturing margin. Okay, Jeff?
Is contribution margin the amount of, I mean, isn't that the only thing that can change based on the number of units produced? Isn't the fixed always stay the same? Like, fixed manufacturing overhead, that will always be the same no matter if we
At
produce,
this range of production, fixed costs are going to be the same. That's true. But to say that's the only thing that's going to change, sales could change, direct materials could change, direct labor could change. Yes, all those are wrapped up in contribution margin, but I didn't want to do an only.
Okay.
Never, always. Okay?
All right.
Are we ready to move on? Get me from contribution margin to net income. Jeff?
Subtract fixed overhead and fixed operating expenses.
Fixed cost and fixed expenses. Fixed cost
60,000?
divided by 50,000 times 45,000?
No.
No. Just fixed cost. All of them are going to be deducted now. Fixed cost 60,000, did you tell me?
Yep.
Fixed expenses
116,000.
116,000. A total of 176,000 of fixed cost. Contribution margin minus everything fixed. Aaron?
71,000.
Auditors? 71,000. So we got 77,000 the first time, 71,000 this time. Have we answered all the questions on the handout? We know gross profit, we know contribution margin, we know net income absorption, we know net income variable. Anybody curious why there's a difference in these two numbers, and would you care to prove it with me? I think we should. It seems to me that we need to know the difference in total. Let's do net income absorption compared to net income variable. Net income absorption was 77,000, yes or no?
Yes.
And this time we got 71,000, yes or no?
Yes.
A difference of 6,000.
Yes.
Help me find that $6,000 difference. Who's going to help? You're acting like this is not review. This seems painful. Chriselle? It is in the ending inventory. You want to tell me about that in total? How about in total? Chriselle, ending inventory absorption was
44,000.
and ending inventory variable was
38,000.
a difference, Chriselle, of
6,000.
well, it's in the ending inventory. Bentley told us that a long time ago. Here's proof. I'm not sure I understand that. You're off the hook. Thank you. Somebody pick it up. Show me the difference. Why is there a difference in net income under the two alternatives? How about per unit? At what price did we value each unit on the absorption cost of the income statement? Do you remember, Aaron? Say it.
$8.80.
$8.80. At what price did we value ending inventory per unit on the variable cost of the income statement?
$7.60.
$7.60, a difference of $1.20, everybody, yes or no?
Yes.
I'm asking you to find $6,000 and we found $1.20.
There's up by 5,000.
Oh, the 5,000 units in ending inventory were treated differently by this amount. 5,000 times $1.20 is,
6,000.
you just knew that conceptually?
I did it right.
All right. Just checking. $6,000. There's the difference. It just keeps coming up. I'm not convinced that you know what we've done yet. What is the $1.20?
Difference per unit.
Fixed manufacturing.
How much are fixed costs? Can you find me fixed costs on either of those income statements? Fixed costs are, one more time?
60,000.
60,000. Fixed costs are $60,000 in this problem. Yes or no, class?
Yes.
Did you see where Toby found it?
Yes.
And if we produced 50,000 units, what are fixed costs per unit?
1.2.
$1.20. Did you just say 110? $1.20. That $1.20 is the difference in the two methods. One method associated the $1.20 with inventory. One method associated the $1.20 with this time period. That's the difference. And you're still going through the rote motions, the mechanics of this, instead of having that, ooh, aha, look on your face of understanding. If we sell all the units, these give the same answer because all the fixed costs are deducted. The fixed costs are deducted under both methods when they're sold. The question here is not about the 45,000 we've sold. Fixed costs on the variable costing income statement for 45,000 are deducted. Fixed costs on the absorption costing income statement for 45,000 are deducted in this time period. It's the unsold units. In variable costing, the fixed costs are deducted in this time period, even when there's an increase in inventory. But under absorption costing, $1.20 for every unit in ending inventory, 5,000, is associated with the inventory and not deducted now, is carried to next time period when those goods will be sold and those fixed costs will be deducted. That's the difference. Shane?
Would the balance sheets both be the same?
I'm not sure that anybody carries variable costing to the balance sheet. If you did, ending inventory will be different on the balance sheet. Ending inventory is the difference here. So this is going to be balance sheet, this is going to be balance sheet. Balance sheet will be different. But it'll still balance because you took a different net income figure to capital. So it's still balanced.
You have more assets and
when inventory increases.
But
Because you took some fixed costs.
which offsets your net.
Right. Now, remember, this is just an internal analysis thing. So I think we stop short of actually doing it on the balance sheet. I think that we prepare it this way. We want to know this information. We make decisions from this information. But I'm not sure that we really book it to make it show up on the balance sheet. It was a good idea. I mean, I'm glad that you wanted to think it through and that we did. Who's got a question about what we've done to this moment? Have we milked it for all it's worth? Do you see a pattern here?
Yes.
I don't mean literally here. I mean in my choice of things to do. Are you getting the message? I don't know how much more deliberate I can be. I would love to work an exercise with you, but I don't think we can even open our books and read it in the 3 minutes that remain.
Which one is it?
Do you have anything to ask me?
Which exercise were you about to work?
Oh, I can tell you that. I could work brief exercise 26.3 or brief exercise 26.7. They were both agreed. I will see you on Thursday, yes or no?
Yes.
Have a nice day.